Hello, savvy investors. Welcome back to the Dividend Uncle channel. Today, we're diving into an update on Cromwell European REIT, a standout performer this reporting season. Despite an overall downturn in the market, Cromwell European REIT has bucked the trend, and there's a lot to unpack about its recent success. In my video at the start of the year, I shared that I was snapping up shares of Cromwell European REIT. Fast forward to now, I'm thrilled to report that Cromwell European REIT has emerged as the top performing REIT in Singapore. While the CSOP iEdge S-REIT Leaders ETF has declined by 14% year to date, Cromwell European REIT has climbed up by about 7%, showing an outperformance of more than 20%. Today's video will delve into whether Cromwell European REIT can live up to the hype, fueled by investor optimism and analyst predictions suggesting up to 40% further upside from its current price. The main question investors are asking is whether we should invest new money into Cromwell European REIT despite its outperformance so far this year. Before we dive deeper, don't forget to hit that like button, subscribe if you haven't already, and let me know your thoughts in the comments below. Your support is crucial as it helps me bring more detailed analyses and updates. Let's get started and see if Cromwell European REIT's current trajectory is just the beginning of its growth story. Let's start off with a quick overview of Cromwell European REIT's performance in Q1 2024. Cromwell European REIT demonstrated resilience and strategic agility, with net property income declining slightly by 2.7% year-over-year to €32.7 million, mainly due to strategic asset sales. Despite this, the REIT maintained a strong occupancy rate of 93.4%, showcasing stable tenant retention and demand. However, its distribution per unit or DPU decreased by 10.2% year-over-year to €3.505, largely impacted by 1. Asset sales for strategic portfolio shift and reduce gearing, and 2. Rising finance costs. This has caused some alarm among investors. Now, let's investigate the drivers of the DPU decline. Strategic resilience, capitalizing on core strengths and long-term vision. Asset divestments for the larger good. Despite the current dip in DPU following asset divestitures, 3 key strategies are poised to enhance Cromwell European REIT's long-term performance. 1. Strategic portfolio shifts, short-term pains, long-term resilience. The notable dip in DPU is primarily due to the impact of strategic divestments. However, it's important to see this in the context of Cromwell European REIT's long-term strategy. Since a few years back, Cromwell European REIT has announced it is oriented towards a realignment of their portfolio towards a 60-40 split between logistics/industrial space and Grade A office space. This aligns with market trends of an outperformance of logistics space, while office space facing uncertainties of work-from-home trends. 2. Logistics sector strength, capitalizing on tight supply. The logistics sector, a cornerstone of Cromwell European REIT's portfolio, is experiencing a tight supply situation which has bolstered the value of existing properties. Most of Cromwell European REIT's logistics properties are freehold, offering the flexibility to hold or develop these assets over the long term, thus maximizing returns amidst a growing demand for logistics spaces. In addition, you will see an alarming figure in the Q1 2024 results, that is, the tenant retention rate for the logistics sector is at a staggering 34%. So what happened? Well, it turned out that this low rate was just based on 2 leases, both of which were priced below the current market rates when they expired. This situation actually presents an opportunity for the REIT to realign these rents closer to market levels upon renewal. The opportunity is underscored by the logistics sector's impressive rental reversion rate, highlighting the potential for increased revenue from these properties. 3. Debt strategy, stability and gearing ratio. Management is explicit in their objective of keeping gearing ratio lower than market averages, at 39.7%, and interest coverage ratio healthy at 3.6 times. This is done through the divestments of non-core assets and paying off high-interest debt. As discussed earlier, these divestments has a major downward pressure the DPU in the short term, but has and will help to mitigate financing cost increases. Financing cost, no significant increases in next 2 years. As for the higher refinancing cost impacting DPU, investors should note that this should not increase significantly in next 2 years. Currently, Cromwell European REIT boasts a stable debt profile with no debt expiring until November 2025 and 86% of its debt fixed, ensuring a steady interest expense. With the European Central Bank expected to cut interest rates in June 2024, the REIT should benefit from reduced financial pressures, supporting its ongoing operations and strategic acquisitions. This will remove one of the major drag on DPU as we move towards 2H 2024. Redevelopment gains, boosting earnings with strategic projects. Looking ahead, Cromwell European REIT's redevelopment projects, like Nervesa 21 and other initiatives in Eastern Europe, are showing great promise. These projects, currently pre-leasing well, at 70% to 90%, are expected to begin significantly contributing to earnings from the Q2 2024. These redevelopments are projected to deliver returns above market cap rates, reflecting Cromwell European REIT's effective capital deployment strategies. The Dividend Uncle's take, balancing immediate challenges with future growth. Cromwell European REIT's recent performance presents a compelling narrative of resilience amid broader market challenges. While we observe some immediate concerns, notably the dip in DPU driven by strategic divestitures and elevated finance costs, these moves are part of a broader agenda aimed at refining the portfolio for long-term value creation. The logistics sector's tight supply and the promising outlook for redevelopment projects indicate robust growth avenues. However, it's important to acknowledge that the benefits of these strategies may take time to fully materialize. Despite this, I remain confident in the long-term prospects of Cromwell European REIT and will continue to invest in it over time, recognizing that patience is crucial for realizing the potential gains from such strategic maneuvers. As investors, it's essential to look beyond immediate fluctuations and focus on the enduring quality and future readiness of the assets under Cromwell European REIT's management. That's a wrap on our analysis of Cromwell European REIT's Q1 2024 performance. As always, keep a close eye on market developments and how they affect key financial metrics like DPU and occupancy rates. Your engagement and feedback drive this channel, so hit that like button, subscribe if you haven't already, and share your views in the comments below. Until next time, stay smart, stay invested, and keep building your knowledge with the Dividend Uncle. Thank you for tuning in.